Good morning. Thanks again for tuning in and joining us this morning for our webinar on Q3 results and what the true state of credit quality is. My name is Sean O'Brien. I'm the president of Quick Rate, and am pleased to be joined on today's webinar by David Ruffin. David joined us last year to build out a new suite of credit risk management tools that we call IntelliCredit. And IntelliCredit, along with Quick Analytics, are recently newly added endorsed vendors of the New Jersey Banker Association. So we're very excited to be working with you and your organization, and we hope you'll find today's webinar helpful, and certainly invite you to learn more about the solutions and the tools that we've built that we think will drive some efficiencies for you at the bank. Just before we get started, a couple of housekeeping items. One, Monday we will send you a link to the recording as well as a copy of today's PowerPoint. Some of the things we're going to talk about today, we're going to start just kind of looking at the third quarter numbers. We run a quarterly report every month, every quarter after the call reports are filed. That just gives you a sense of what's happening both within the state and nationally. And then we'll talk about some economic signals. Certainly they're mixed, but I think the clear evidence right now is that a lot of things have been good for Wall Street, but not necessarily Main Street. David's going to talk more about the state of credit quality, and then we'll just show you a few things that are new at Quick Analytics and IntelliCredit, and again remind you that we just were recently endorsed, and then certainly invite you to give us a shout. Okay, so as I mentioned, Quick Analytics, we are a comprehensive source of call report information. So one of the things that we like to do every quarter is once those call reports are filed is to put together some numbers. We do them both at the state and national level. So here you can see we have what we call the QCBI, the Quick Analytics Community Bank Index, which is essentially the definition that the FDIC provides for community banks. But it just is a way to draw to some distinctions between some of the larger banks in the country and community banks. So you can see there's 60 banks in New Jersey. 8 of them get excluded from our index in the numbers that you'll see. Asset growth has been very good across the country. It has been as well in New Jersey, a little bit lower than the national trend. All of these numbers you'll see are the state numbers. They're state median numbers, and then the red line represents the national median. So as we move through these, those are how you should evaluate these. We also break things down by size. So up in the right-hand corner, you can just see asset growth by percentages, and then in the lower box in the middle, asset growth just by the asset size of the bank. So you can see it's a little bit choppy in terms of asset growth, even though everybody has experienced good asset growth over the last 12 months. Deposits the same way, pretty strong deposit growth. Needless to say, we are in the liquidity business at a Quick Rate, and there's plenty of liquidity. Banks are awash in liquidity. I will say, however, if you are in a local market that still has stubbornly high rates, there is plenty, and I repeat, plenty of available low-cost wholesale money. So certainly don't pay more than you need to in your local markets. Again, the deposit growth has been kind of good across the board, but certainly the larger banks have seen the biggest rise on a percentage basis. Now we get into some of the tougher numbers. So this current environment has been tough for a lot of different sectors. It's certainly been difficult and will probably continue to be difficult for banks. You can see, and you already know better than I, yield on loans, the pricing with rates dropping has gotten much more competitive. New Jersey traditionally has been, very competitive on loan pricing, but the pricing is below the national trend and has, dropped in the last 12 months, 46 basis points. The cost of funds has seen a nice drop as well, over 52 basis points, but the combination of those two has still resulted in about a 30 basis point decrease in NIM, and that's clearly going to be at the forefront of our challenges as banks, over the next couple of years, as it seems likely that short-term interest rates will remain close to, if not at, zero bound, and that environment will mean lower prices on loans. It'll mean lower yielding security rates. So just a very, very difficult environment to start with, and then the potential for layering in any credit costs, makes the challenges ahead, pretty significant. Non-interest income has stayed pretty steady, slightly declining, but certainly well below the national trend, and the efficiency ratio has crept up here in 2020. So again, a lot of headwinds for us as we move into 2021. That's resulted in median pre-tax ROA of 71 basis points for the state, again below the national trend. And then a second number, and as we move to the right, you can see by asset size of the bank. This is kind of somewhat unusual. I attribute part of it just to the smaller number of banks in each of these categories. But the interesting that the next highest median is between 0 and 100 million, where these banks between 100 million and a billion are a little bit more choppy. The highest median pre-tax ROA at banks above $1 billion, which again typically is what you see is a little bit more of a slope line like this, as a lot of the larger banks are able to take advantage of more technology to build efficiencies into the banks. Core operating earnings, that's what the COE stands for. This is a measure of pre-tax, pre-provision type of income. We exclude a lot of the one-time items like loan losses, gains and sales on securities, et cetera. And so this is always what we feel is a very good measure of just the true operating profits, of banks. In addition, with the deposit franchise being the most, valuable thing we have as banks, the next biggest thing in our mind is core operating earnings. So we focus in on that a lot to see where banks are able to generate their earnings. So again, we've seen a 13 basis point drop. It's been kind of across the board, but the largest banks still driving the highest core operating earnings. So needless to say, again, a lot of challenges. This makes sense, and those would follow through into ROA and ROE. So you can see those numbers: 53 basis points median ROA and 4.77 median ROE for banks in New Jersey. If we come over here to the right, the largest banks at 10.1% ROE, and then everybody in here just under 5% ROE. Okay, so as we think about all that and then what we have to look forward to, we've kind of made this point throughout really since March, but then the Federal Reserve, certainly in their minutes have been pretty consistent about it as well. We've all heard this, probably more than we want to, but essentially the path of the economy is going to depend on the course of the virus. It certainly appears now we are making progress towards a vaccine. Distribution of that will still take some time. So, needless to say, we're looking at, still a continued difficult environment for the next 6 to 12 months. 2020, GDP, I think, again, numbers can be funny things. We're big believers in, both at Quick Analytics, but also just within our banks, suggesting that we stick to a preferred measurement of how we look at numbers. One of the things that can be very disconcerting and just to me in some ways frustrating is that, particularly around GDP numbers and just other economic numbers, that we jump around between what the actual numbers are and what the annualized numbers are on a quarterly basis. So, I think it's important as you think about it and you're doing your, estimates and just expectations, always try to stick to some kind of consistent reporting base. And that's, again, kind of at the heart of what we try to do with the call report information at Quick Analytics is let the numbers, finally be an objective arbiter of truth. So GDP numbers, you can see here, bottom line, right now, the economy is 3.5% smaller than it was at the end of 29. The loan-to-deposit ratio in the industry is at multi-decades lows with the huge influx of deposits. Debt to GDP exceeded the size of the economy for the full fiscal year, and that's the first time that's happened in more than 70 years. And that trend of increasing debt at the federal government level, I think, is with us for the foreseeable future. So, again, it all brings to light that we are not really going anywhere economically until we get this virus under control. Some more economic numbers, and again, I think it's worth repeating that what's happened on Wall Street isn't necessarily reflective of what's happened on Main Street. We are still 9.8 million or 10 million jobs short of where we were pre-pandemic. If you think about the last month's jobs numbers where the economy created 245,000 jobs, at that pace, it will take 40 months to get back to pre-pandemic levels. So that's over 3 years. And if you think back just to a month ago or 2 months ago when the economy was producing 600,000 jobs, it's a stark difference, because then it would suggest that the economy would get back to pre-pandemic employment levels in a little over a year. Well, that deceleration is very concerning, and it's exacerbated by the fact that 2/3 of the people who are unemployed today are relying on programs from the CARES Act that was passed earlier this summer, and those programs expire on 12/26. This week, the new unemployment claims were 1.4 million. That's the 38th consecutive week where we've had over 1 million claims. So even though it feels, if you look at the stock market, that the economy is on very strong footing, the underlying numbers would tell you a different story. And I think that's the divide between Wall Street and Main Street. And the way I characterize this, the easiest way, is every time a business on Main Street closes, probably a Wall Street business increases their market share. And that's really what we're talking about. Small businesses are closing. Larger businesses are stepping in because they have the capital and the balance sheets to continue on. So, I think there is going to be more need for fiscal support, and we'll see if any of that happens here in the next month or so. Again, some GDP forecast. Now, I broke my own rule here by showing them to you annualized. But the reason is because you can see the third quarter number annualized showed over 30%, right? That's not really how fast the economy grew. On an annualized basis, it did, but that was really only one quarter. So I think it's important to remember what we're really looking at as we move forward. Okay, so I think, again, as we drill this and bring it back to us at the bank, what does this all mean? And I think part of it is, trying to set a tone. And David will touch on this in greater detail, but what tone are we really looking to set internally and for our regulators as we think about our bank and our credit quality moving forward? Certainly in quarter two, we saw pretty much across the board loan loss provisions increasing. The third quarter, it's been more mixed. Money centers and many of the regionals started to slow their provisions. Some have even pulled back some reserves. So again, I think that's creating mixed signals. There are certainly reasons to be positive. Net charge-offs are obviously low or non-existent for most banks. Reserve balances have been increasing. We are, for many of us, still continuing to see steady loan demand. It's likely we'll see another round of PPP loan or programs, either at the end of this month or in early the first quarter. There is plenty of capital and liquidity on our balance sheets. There is, increasing consumer confidence, with the sight of a vaccine, being within sight. And then I think different from the last crisis a decade ago, where a lot of the problems were caused by 1 to 4 family, home prices have actually obviously been a strength for not only, banks, but for borrowers, right? I mean, prices have pretty much increased across the board. In many markets, there's not enough homes. It has really been a source of strength. So, plenty of reasons to be positive. On the other hand, there are plenty of reasons to be cautious. Again, quantitatively, a lot of things look good on the surface. Qualitatively, not so much. The virus is still not under control, and the next coming months in winter are going to be tough ones. They're going to be difficult for everybody, and the inability for people to be outside and have the virus get worse is probably going to increase anxiety, which again is not healthy for any of us. Margin deterioration is probably likely to continue with low interest rates. The economy is smaller. Is there an expectation next year that taxes might increase? Maybe not next year, but in the subsequent years. Unemployment is coming down, but still higher than we'd like it. Again, nearly 10 million people are out of work from pre-pandemic levels. And then, I think it gets down to we have to see what really kind of condition our borrowers in, and can they survive another 6 to 9 months of these current types of conditions. So, it goes without saying, and I don't mean to be overly pessimistic, but there's certainly a lot of uncertainty around the actual condition of our borrowers. And that's why, while we're optimistic with the vaccine and things are, hopefully there's an end in sight, we do think there's potentially some credit tails that, can arise. And so with that, I'm going to turn the presentation over to David, and he's going to take you through the next part of our presentation.
Thank you very much, Sean. I hope you can see the screen. We, as Sean alluded to, of course, much of the data that's been presented in this webinar so far has been from our sister division, Quick Analytics, which deals robustly with public data. The heart and soul, frankly, of IntelliCredit is non-public data, which is idiosyncratic from the individual banks, information that doesn't make it yet to the call report. And we think, frankly, that's really the art of credit risk management is understanding emerging credit risk in those early indicators well before it becomes public knowledge as a criticized classified loan, for example. IntelliCredit and some of the things we'll show and describe today will be based on two primary concepts: our portfolio analytic tool and the tie to loan review concept that are wed together in the same portal. Three general areas of lending have always been predominant, and one is growth, one is quality, and one is yield. Certainly, Sean has already alluded to the yield. Let's talk a little bit about loan growth and loan quality. Loan growth, not unlike asset growth, has increased all over the place, but a lot of that is really non-organic loan growth. We know that through the PPP loans. Even in New Jersey, while a tad bit below the national average here, that still has been very robust through the third quarter of 2020. And the larger banks, in other words, the banks between 1 and 10 billion, are leading the parade on that, so to speak. In terms of quality, I think these are very good numbers for the state of New Jersey, and everything we're going to look at here, again, as Sean alluded to, we look at our universe are banks 10 billion and under in assets, because we think as you get up into mega bank territory, it skews a lot of the comparative data that we want to look at our banks. And one of the things that I have always looked at from a quality standpoint is in working with boards and management is in fairly simple terms. You've got your inventory of acknowledged problems, and then the question is, what do you do with it? You either charge them off or you reserve for them. New Jersey is below, and in our world, our region is the mid-Atlantic peer group of states, as you see below. But New Jersey is actually below the peer group and the national average in terms of 83 basis points of acknowledged problem loans as we speak today. We'll talk a little bit about that conundrum, frankly, going forward. Net charge-offs, as Sean alluded to, are inconsequential these days. Almost no one's charging loans off at this particular point in time. But on the other hand, people are anticipating credit stress continuing to increase. In even the post-COVID environment, I think most people are adding to reserves. Again, New Jersey is a little bit below the national average, as is the Mid-Atlantic, but that's not that's pretty standard expectation and logical. Another way of looking at it is how much of your reserves collectively in the $10 billion banks and under in New Jersey are covering your at least acknowledged inventory of problems. And again, good news. New Jersey's covering 2.25 times your acknowledged inventory of current problem loans in your reserves. So what do we do? Sean's, one of his last words in his presentation was uncertainty. I don't think there's any question whatsoever that that's the operative description of the credit environment that's been left by COVID-19. It is uncertainty. I'm not here to cry doom and gloom. That's not my point. It is the issue of, I think, vigilance and trying to minimize or reduce the uncertainty, particularly going into 2021. So over the uncertainty over the short and long-term effects of the economic shock itself, certainly over the impact on your loan portfolios in terms of quality and growth, over the disparate impact on industries. Again, Sean alluded to the fact that a decade ago we had really one commodity, if you will, one-to-four family housing valuations that took the whole country into a financial crisis and a recession. COVID, unfortunately, has left us with many disparate impacts on different industries, some good, some bad, some very bad. And I think that is added to the complexity of how we have to analyze and assess our credit portfolios in this environment. Certainly uncertainty on the impact on bank valuations. If you talk to investment bankers today, they will tell you never in their careers have they seen such unclear signs about where embedded credit risk may be in bank portfolios. And that's certainly lending itself to the fact that bank valuations, even in the stock market, have not appreciated to the level that so many other tech level rebounds have been realized that we've seen lately. Uncertainty, as Sean said, over the fate of the economy being tied to the virus, and there is certainly hope that vaccines and therapeutics will help once and for all end the COVID crisis, but we don't know when that will be. And of course, the good news, again, as alluded to earlier, we have more capital, more liquidity, better risk management. Unlike a decade or so ago, there's certainly no blame to the community banking industry. In fact, there's, if anything, of late, I think the community banks have tremendous goodwill in the marketplace, particularly relative to their energetic distribution of the PPP loans. And we'll touch on that at the end of my segment again as to another aspect of how we can continue to preserve or build on that goodwill in the industry. So what do we need to be doing for 2021 in terms of credit? I do believe that our current credit quality metrics are misleading. We're experiencing a COVID high, potentially masking credit deterioration in all of our bank portfolios. A lot of that comes from three predominant factors, and that is we've had a massive federal stimulus and uncertainty yet over even more to come. Unlike a decade or so ago, much of that money came quickly to the street and helped us get through the shock of this crisis. Obviously, regulators have given the banking industry a bit of a respite this year over TDRs, suspension, over the allowance for more aggressive extensions and modifications. And then we've had just this flush of non-baseline loans and deposits that have given us somewhat of a false sense of comfort around this crisis. Again, but as was clearly said by Sean, our credit, everyone on this call, I think, would adhere to this. Our credit lives on Main Street, not Wall Street. Irrespective of the Dow's record recent recovery, we're in a recession. 50% of Americans who don't have either direct or indirect involvement in the stock market through 401ks, in many ways are living paycheck to paycheck and are in survival mode, not investment mode. And these are the bulk of our consumer and certainly small business borrowers. And as we all know, those of you that are on this call as credit management specialists understand that's a classic red flag for traditional credit risk. So what should we consider doing in 2021? I'm going to talk about 8 action items that might be worth your consideration for managing credit risk in this rather unique COVID and maybe hopefully post-COVID environment. One is to know our concentrations. That's an obvious, and we're looking at numbers here also from quick analytics on on New Jersey. This we think so often at the community and regional bank space on CRE concentrations, and of course we depicted here the 300, 100, the broader 300. There are non-banks in New Jersey that exceed the 300% guidance. There's one bank in New Jersey that exceeds the construction development 100% guidance on that subset of the broader CRE, which of course doesn't mean it's it's a violation of a regulation. It just means that there's even more imperativeness on explaining why you're either at or exceeding those guidelines. But I think, again, as I said earlier, COVID is leaving us with a lot more of a breadth of need to understand where are concentrations coming from other industries or other borrowers. New Jersey, not surprisingly, leads in multifamily exposure. The middle chart here is what I tend to call funny money, because it really, and I feel for all of you in the banking world that are trying to spend time on strategic planning for loan growth and excuse me, organic loan growth for next year, because we've had such a massive spike up in C&I loans. Again, a lot of that is PPI. Not surprisingly, of course, unlike banks in the Midwest, New Jersey is not heavily involved in ag lending. But the reason that I wanted to talk about concentrations is the FDIC sponsored a study that was published last summer that was excellent relative to failed banks in the last crisis, and it basically said that 70% of those bank failures were CRE lending focused. Not surprising, we know that. But other aspects of it were the high concentrations and late cycle growth, or what we call vintages, or lack of loan seasoning. In other words, loans that were made late in a very healthy or benign credit cycle oftentimes become the most toxic in a period of credit stress. Excuse me. Also, there's a high correlation to collateral dependence, which is the worst of both worlds, because when you really need collateral, oftentimes pressures on collateral valuations are at their greatest. And of course, there are state and regional market forces that were critical covariants. I do think this whole study can be also applied to any form of concentration that you might be faced with as you look to manage your credit risk. And particularly as it relates to CRE, that even since the financial crisis, look where we are in terms of commercial banking. CRE now in the whole banking space has now matched the exposure to residential lending. And if you take communities and smaller regional banks, I would argue that number is probably even exceeding residential lending. So how do we look at our concentrations? Again, certainly looking at it by band or loan types would be important. These are depictions from our tools at IntelliCredit. Understanding your concentrations relative to your average risk-based capital or community bank leverage ratio, whichever approach you're now using. For example, we had a customer in Nebraska that has 650% of his risk-based capital tied up in ag loans. But he's able to quickly disabuse a regulator's concern of that because he's able to show that he has a fairly pristine ag portfolio. This is the kind of exercise that I think you're going to be challenged with throughout all of next year with the regulators, is explaining what might be implicit of adverse exposures or concentrations such that you need to be in a position to allay their fears that this may be problematic for your bank. And if it is problematic, start beginning a process of explaining how you're mitigating that. Recognize the varying COVID impact on our borrowing industries. As I said before, never before have allegiance to things like NAICS codes or industry characterizations been more important in banking. And that is the ability for your bank to understand, for example, in this case of looking at hospitality loans or restaurant loans that may have significantly different credit risk profiles than other industries. Your need now is going to be able to look at your portfolio as the sum of many parts. In my opinion, it's no longer even reasonable to be thinking of your portfolio as just one entity and how it's performing as a single entity. You are needing, I think, to subset your portfolio, whether it's into the COVID effective loans, the PPP loans, or you may be having you may have a significant amount of SBA loans or asset-based lending loans that you want to begin to treat and analyze and understand in a separate context, and getting or having the ability to do that in a practical, technological way, I think will be very, very helpful for you to understand your portfolio subsets, vintages, and hotspots. Another example of this, which is one of my favorite approaches and looks are, here's an example of a bell curve depicting risk grade migrations within past categories, I might add, which again, for us credit people, we tend to, I think, focus on that because we know that emerging risk in those past categories or deteriorations in those is really the art of credit risk management. So the chart to the right, on the other hand, is a subset of the portfolio as a whole, which shows residential construction lending perhaps migrating a bit to the right in terms of the bell curve, which implies, while not yet criticized classified, it does show some deterioration of credit. Having your ability to do this type of analysis to begin to show your management and your boards and your regulators where you are on these emerging credit risk and what the post-COVID landscape has left you, I think is going to be critically important in terms of effective credit risk management next year, and also your, frankly, relationship with regulators. So identifying the stressed borrowers, many of you are already deep into this, what I call tedious process of determining, frankly, who the winners and losers are in your portfolio relative to the COVID environment. And again, we are using an example here is where a lot of the qualitative aspects of managing the credit risk associated with those are going to be tedious, but I think quite necessary into giving you the ability to understand which borrowers are survivors and which are not. And again, I hear this quite often from bank practitioners. We're just waiting for the next shoe to drop in terms of what the credit COVID environment leaves us. Adjust our credit management focuses. A few different ways of looking at it. We've already talked about this aspect of it. I think some talent assessment is probably in order. We haven't needed special asset or problem loan management talent in years in the banking industry, frankly, because of benign credit. That may unfortunately come to a bit of an end in the next couple of years. I do think you should look at your policies. Some of the policies that you've got in place reflect a much different environment economically and credit-wise. We all know that one of the traps you tend to walk into sometimes is regulators will look at what your policy says and then compare that to what your practice is, and if it's not in sync, then obviously you get criticized. I think we're in an era now where conservatism without overreaction is going to be the name of the game. Certainly stress testing at the portfolio level and the loan level, which we can certainly offer. But also I think that while many of you on this call are probably not technically mandated to do stress tests, we're hearing this anecdotally almost everywhere that regulators are beginning to strongly suggest stress testing of community and regional bank portfolios, particularly as a result of what they think the effects of COVID may be. I do think because of the ability that we have now, the big cushion of capital that we have in the banking industry, we're going to be into a focus much more on reserves than charge-offs, which frankly dominated the last financial crisis, which was really more focused on charge-offs, and probably largely because we just didn't have the capital as much as we do at this point. We'll end by talking about government guaranteed programs a little bit in a moment, but also, again, avoid the trap of all loans are good loans until they're bad loans, because that sounds a little trite, but it is a trap that I think we bankers get into sometimes, overthinking, well, we're not really understanding emerging credit risk in the nuances that they begin to show in the early stages. And we also know that there's a strong correlation between the early detection of credit risk and the ultimate losses that we incur through problem loans. I do think it's important for you to begin to look at using any type of practical and affordable quantitative tools that you might have at your disposal to do some of this analysis to identify emerging risk, and certainly at a level that's far more revealing than just that someone's past due. Again, focused on risk grade migrations within the past categories. I think it's very important that we make loan review more effective and efficient. That is one of the hallmarks of IntelliCredit, is to try to bring loan review out of the wilderness of just a one-off engagement, almost an audit-like process, to make it more real-time and interactive with analytic analysis of your portfolio. And I do think that's very important, as the regulators, as you know, were already pre-COVID concerned about the quality of our credit risk review systems on the presumption that we were going to have a change in the credit cycle anyway. And the final issuance of this came in May of this year. And there are things that I think we have to understand. Why this is a bit of a concern is that there's been a backlog of a lot of loan review because of just the practical implications of COVID, not being able to do loan review as robustly, and there's been a backlog of it. And of all things that I think you don't want to be caught in is a sense that you're behind schedule on doing loan review or effective loan review. Again, in our world, we like to try to think of bringing loan review in a very interactive and a very dynamic way, associated in real time with portfolio analytic work. Some of the things that I think are going to be very, very important for loan review is to make sure that whoever is doing your independent or external loan review is qualified. It's no longer adequate to just have a neophyte out there doing kind of check the box on documents in a credit file. You almost need to have someone that's seasoned enough to frankly challenge assumptions within the bank, now more than ever, because there may be a requirement to do that. And again, the early detection of problems within a loan review process actually it's not a negative, it's a positive. It saves money in the end. So a few of the other questions we like to think about, again, is it culturally in sync? Does it have any relevance to your portfolio risk assessment? And does suppressing of the loan review work through much of 2020 have some potential to exacerbate more losses later? Number 6 was know our vulnerabilities. While the Texas ratio, again, is almost inconsequential, obviously it's improved from the years of the last crisis. But one of the things we have to realize is that smaller banks have structural disadvantages when we have waves of credit problems. One of those is capital. The second is highly subjective and qualitative, which is in many cases smaller community banks and regional banks actually know their problem and stressed borrowers, and it makes it more difficult to deal with that personal aspect. And thirdly, we're heavily connected to real estate, and that is arguably the most illiquid of all problem assets and problem loans. And even in New Jersey, as you can see, in the larger acknowledged inventory of problem loans, even though it's highly clean and by any standards, it still remains very clean and benign. It's the $250 to $500 million banks in New Jersey that are currently holding the existing NPLs. And again, if we have another wave of that, you want to be concerned about it. Number 7 is to write your own credit risk management profile before the regulator does it for you. That, again, seems rather obvious and logical, but again, I think of all the things we talked about, that may be your most daunting challenge in 2021, is be sure you are ahead of the regulator in understanding what is unique to your own bank's credit risk management profile, because they will certainly write it for you if they face a vacuum. Number 8 is finding an alternative source for loan growth. We all know that, as Sean alluded to, the economic stresses have basically created an environment where the traditional quality of loan borrower has been reduced, and sources for traditional organic loan growth are going to be even more challenging in 2021 and probably into 2022. One source is clearly to go ahead and embrace government guaranteed lending. Earlier this week I spoke on a webinar with one of the larger providers of SBA lending and USDA lending, Holtmeyer and Monson. And the point there is that this would be an opportunity for you to either convert some of the PPP loans, certainly create some more organic loan growth under the patronage of an additional underwriter of the risk. Again, this is the point of I said earlier about continuing the goodwill garnered by the PPP programs and being seen as an active embracer of the SBA or USDA lending programs in a way to provide legitimate lending in a very stressed time for these so-called Main Street borrowers. And of course, there's some profitability associated with that from the fees and the secondary market sales associated with that. So, having said that, I believe that we are into another slide with Sean, and I appreciate the opportunity to be with you today.
Thank you, David. Yes, and so just to jump back and just talk a little bit here before we close, just a reminder of some of the things we're trying to do at Quick Analytics and IntelliCredit to help you navigate this environment better. For those of you who haven't looked at Quick Analytics, we have a number of tools, including a portfolio stress test. We'll be adding bank market research data that includes FRED data that you can do research on lending. We are updating our portfolio credit stress test solution. We are actually making it a lot more interactive. We have a webinar coming up in December that will discuss how banks can use it, but it's a very easy way to run a portfolio level credit stress test. So again, it's just some actionable items that you can incorporate into your own analysis. It allows you to build in your own internal capital target levels, as well as factor any potential capital raises, look at your own periods of stress, and pick the appropriate time period. So again, just trying to, where we can, save you time by doing a lot of the data aggregation work so you can spend your time analyzing the results. For those of you who have seen it, we do have what's called an Excel add-in tool. One of the requests we've gotten from users is to incorporate credit union data so that they can see that when appropriate. So we will be adding that in February with the year-end call report release information. As I mentioned, we have the FRED data we'll be including for the larger banks. If you are looking for an investor relations solution, if your bank is traded, there's some recent SEC updates about requirements in order to have your stock traded. Our page will accompany or address that and allow either for you to host it or for us to host it. And this is just an example of that. So I think the bottom line, what we're trying to just demonstrate is that we've tried to continue to build, much in the spirit of what QuickRate has been doing for banks for 30 years, is build affordable, easy-to-use solutions. We understand if you've got things in place, but if you're looking for ways to drive some inefficiencies, we think we've built some really not only affordable solutions, but very efficient solutions. And it's a way to just evaluate and improve some of your services. So I'd encourage you to do that. As David mentioned, IntelliCredit can assist. For those of you who have internal loan review departments, we can drive efficiencies there, and then you can enhance your current loan review experience if you use external by incorporating our portfolio analyzer tool, possibly at the same cost of your current loan review. So again, we recognize the challenges banks are facing. We're trying to give you options to drive efficiencies and maybe save some money on multiple vendors. David, I don't know if you want to take this, or I'll take. Go ahead.
Yeah, I just think that the real key to it, if you don't mind, is just reminding that can you navigate between macro and transactional credit risk is going to be the real key of understanding what macro trends may show, but then can you explain what individual transactional borrowers are creating, those either positive or negative trends? Again, the name of the game next year is going to be, do you know your credit hotspots, and do you have the capabilities to subset your portfolio in an efficient way, as Sean just alluded to? Can you customize any view of your portfolio to write your own script And does your loan review interface in any way with portfolio diagnostics? Because I do believe loan review is going to be back in heavy attention in the next 2 to 3 years. And I would say that I'd like to, this again sounds very almost a platitude, but avoid too many credit surprises. I've worked with management and boards for over the years, and I have found that that is the one toxic issue that tends to get in the way between boards and management, is that if one, particularly boards, feel like there's way too many credit surprises. There always will be credit surprises, but what we don't want to have is too much, too many, because it conjures up either an issue of transparency or competency at the management level. So having said those, these are the tools that we feel like that the IntelliCredit Portal credit risk management solution offer you. It stays on top of your risk. It gives you your credit hotspots. It gives you your instant reports any way you like it if the data exists. And it has an interface and interactivity with your loan review, which, as Sean said, can be done internally or to enhance a third-party loan review experience.
Okay, thank you, David. Again, we certainly, if there's any questions, we will take those now. There is an icon if you have any questions as we wait just to see if any come in, or if they're already here. Let me check. In the meantime, if it doesn't appear that we have any questions today, I would thank you all very much for taking time out of what I know is a busy day to listen to our presentation. We are proud to be associated with the New Jersey Bankers Association. We appreciate the opportunity to present to you today. We'd invite all of you to schedule a tour of Quick Analytics, or share a flat file with us and we can show you what IntelliCredit can do, or if you haven't scheduled your loan review for 2021 yet, certainly maybe ask for the opportunity to submit a proposal on that. We'll leave the screen up for you, but otherwise, be safe, be well. Thanks again for joining us, and let us know if we can be of help to you. Thank you so much.